Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview. I'm delighted today to be joined by Dr. Philip Verleger, who is principal at Verleger LLC, based in Denver, Colorado. Thanks so much for joining us, Dr. Philip, today on Halftime Talk.
Thank you for inviting me.
Let's talk a little bit about your views on the trajectory for oil prices in general, longer term, taking into account the recent sort of OPEC plus output policy, which has been managing supply, trying to balance markets, etc. And also in the context of the energy transition and all those other factors that come into play. Do you think that the Saudi-led OPEC plus policy has done a good job in the last 2 years? Has it balanced markets, do you think? Has it tempered volatility, in your opinion?
No, to the contrary, it's increased. I go back and I've looked at data and I've written about this. The greatest period of price stability occurred while Zaki Yamani was the Saudi oil minister. He managed to work, the Saudis adjusted production and they kept prices volatility very low. Volatility today is roughly 20 times as high as it was when Yamani was managing the market. And so I think the OPEC and Russia have done a terrible job of managing. If this war expands and becomes worse, there's a real possibility that much of the industrialized world will look at this and say, enough with oil. Oil has led to several Middle Eastern wars. Why are we using oil? Now, in 1973 and the following years afterwards, we could not go anyplace but the oil industry. They had all the technology. They had everything that they could that we needed to kind of respond to the embargo and the pursuit of energy independence in the United States and Europe. Today is very different. The oil industry is pretty small in terms of the equity markets. We have many new innovators, and it is really possible, if this thing blows up, that the world just says, enough, we don't need oil anymore, and one could accelerate rapidly away from oil. So
okay, well, let me just take you up on that. I mean, that is many people's opinion already, even without things blowing up even further. Obviously those who are pushing the transition, those who believe that it'll come more quickly. Others will say it's happening. We are transitioning. We need to be cleaning up our oil rather than trying to replace it. And anyway, it's going to take another 10, 20 years before we can, especially developing and emerging economies, can even rely on those new technologies. So yes, lessons may be learned, and we're already on that trajectory. But are you of the camp that says how quickly do you think we can transition away from oil? Some are saying peak oil demand will be in 5 or 6 years' time.
It's the question, having followed the change in technologies in telecommunications, in computers, in automobiles, in many other areas, the rates of transition depend significantly on the willingness of the public to move ahead. Over the last year and a half, the support for moving towards the net zero in 2050 has slackened. I mean, you look at the upcoming meeting of, I guess it's COP27 in the UAE, and it's the environmentalists have lost a lot of hope. Maybe we get to net zero by 2060, maybe 2070. That's kind of the path we've been moving towards. It could shift to 2040 if the situation in the Middle East blows up. And particularly oil could go away. The shift could be temporarily to coal with carbon capture. Many other changes can happen. If you look at what happens after a major event, not just in oil, but look across history, Pearl Harbor, for example. the attack on the United States. The United States was producing a few planes, maybe 25, 30 planes a week. We were producing 1,000 planes a week in 4 years. So the situation, this could be an important turning point for the world economy and for the future. So the peak oil could come 2 years from now.
Dr. Philip, tell me about, I mean, you're talking about how you think the last year and a half has sort of reversed the transition momentum. Others would say actually it's pushed certain areas, like, for example, Europe had to become quite more, suddenly overnight more independent from the Russian supplies, etc., particularly gas. So it kind of reinforced that need to sort of speed that up. But just let's get your perspective on the US and how you think it is. What's the status, do you think, of the oil sector there today in terms of the level of production we're seeing? And do you see that stabilizing where it is, around 12 million? And how is the transition going to progress, do you think, there? You could look at the US almost as an independent player, if you like, in that sense.
Well, one, the United States, in terms of economics, and I'm an economist, and oil's been the subject I followed. The United States is now an energy exporter. So for years, every time oil prices went up, the dollars went down. Today, what is happening is, because the United States is an exporter, the dollar strengthens as oil prices go up. The merger that was announced this morning by Chevron and Hess, combined with the Exxon's acquisition of Pioneer Resources, is going to strengthen U.S. exports. What's happening is the major companies are acquiring the smaller independents. The smaller independents were essentially followers of OPEC. Every March there is a meeting in Houston. It's now S&P owns it, but it was CERA.
Yes.
And at that meeting, there's a dinner between the independent producers and the OPEC producers, and the independent producers, following 2020, agreed essentially to work on increasing dividends to their shareholders and not trying to expand production. The head of Conoco was vocal in saying he was very worried that Exxon was going to expand production because he was worried OPEC would respond. Exxon doesn't care what OPEC does, nor does Chevron. They're going to boost production if they can do it profitably. So as more and more production falls into the hands of the majors, the Exxons, the Chevrons, U.S. output's going to go up. And these companies have developed technologies to increase recovery. So the U.S. supply, which looked like it was going to plateau, will probably increase by 1 million barrels a day or 1.5 million barrels a day.
What about the appetite by the energy sector in the US to take advantage of the IRA incentives there? That's been quite successful so far, hasn't it?
Well, yes, it has. And this is where being an old man comes in again. We had lots of measures that were pushed on the energy industry after the 1973 crisis. We had a synthetic fuels program. We were going to develop natural gas out of synthetic fuels. A couple $1 billion went into that, which is maybe $5 or $6 billion today, like the amount of money we're spending on hydrogen. Nothing came from it. The plant was scrapped. Nothing came from it. So some of the ideas, building battery plants in the United States, if people go for electric vehicles, will work. And I think the electric vehicle will become dominant around cities. I mean, the Federal Express, the UPS, other delivery services and so on, like electric vehicles because they can charge them at night and bring them around, as long as the grid has the capacity to provide the recharging. Long distance drives, I think petroleum will remain for a number of years. We just drove to New York and back to see some museums and see friends at various spots in the country. You couldn't find any place to charge an electric vehicle. Now, we don't have an electric vehicle, but one of the things I was doing was looking, gee, what would I do in Indianapolis? What would I do? So that, the charging structure that President Biden is pushing will come in maybe 3 or 4 years from now, but it's going to take a lot of time. And meantime, there's a lot of opposition to electric vehicles. We have an auto strike. The auto workers are pushing the auto industry to make sure that they don't lose jobs for electric vehicles. It takes fewer people to make electric vehicles. It's going to be slow. The interesting point, though, is the real threat to Middle Eastern oil producers is China.
Mm-hmm.
China, the Chinese BYD is pushing hard to sell millions of electric vehicles across the country, across the globe, particularly in developing countries. They'll probably supply the solar power to charge it too. And one thing has come. It used to be that one would order 3 or 4 or maybe 6 ships to carry automobiles a year. Now there are 180 ships on order, according to the New York Times, and BYD has ordered them all. And so what is happening is China, which has seen it's lost some areas of export, particularly in the trade war that our former president started with them, is now looking to just start flooding the market with electric vehicles. Europe is very worried about this. In the United States, not so much, because the cars tend to be small and too small for many uses in the U.S. But the China is coming for the electric car market, and I wouldn't be surprised if in 5 years half the vehicles moving in your country are Chinese electric vehicles. That is a huge threat to the oil market, and it's been missed by most people following oil.
Okay, well, I'm glad you mentioned that. You took the words out of my mouth. I was going to say that China was progressing a lot more on that front. But let's talk about China also in the context of, you're an economist. You said, let's talk about its economy. And again, how that today, in 5 years, 10 years time, we might be seeing more electric vehicles there. But today, in terms of the slowdown, let's say, in the acceleration of growth in the Chinese economy in the last year or two, what's your take on how that's going to continue? And its impact, obviously, on demand for oil. It is the main consumer, if you like, around the world, at the top with the US, India following close behind. But how negative an impact do you think that is? That the Chinese economy is now slowed down to a new pace of growth.
It's hard to say because the data are opaque. But the collapse in the housing market in China looks to be very serious. You have Evergrande, which is one a construction company that is close to bankruptcy. You have Country Garden, which was a stellar performer, which is worrisome. Housing sales are down dramatically, and what this has done is essentially undercut consumer confidence. It is, one of the things I was hoping to do as a young economist after I spent 2 or 3 years following energy was focus on something that are called Minsky moments, which are economic collapses that just kind of are self-fulfilling collapses. We had one here in the United States in 2008 when Lehman Brothers failed. And the consequences, we're still seeing the consequences 10 years later across the world. I've now seen several articles that suggest that China could face one of those because the local governments rely so heavily on selling land to property developers, and property developers aren't buying land. These governments are deeply indebted. The federal government's indebted. You have a situation which is beginning to look a lot like an economy that's going to have significant problems for 4 or 5 years, and that will feed over to oil. And that's why I looked at BYD and the electric vehicles. China, I think the economic planners in China are looking for how can we boost exports, because exports make up a significant portion of their GDP. How can we boost and get the economy going again? And the electric vehicle and solar panels are probably the key things that they have real comparative economic advantage, and if they include those with their Belt and Road, they can push those ahead rapidly. And so just as they built their massive railroad structure in the first 10 years of this century, we could see them pushing electric vehicles very rapidly. I mean, this is the kind of change that could come, particularly if the oil markets are disrupted.
And what about then Russian oil? We haven't talked about Russia, obviously, and the Ukraine war, which, we're now 18 months into it. As we know, there really hasn't been much disruption to Russian oil flow. I mean, disruption in the sense that they've been rerouted, but we're still seeing it get to certain destinations. That oil price cap hasn't really done much. It has changed a bit. It looks like it's a bit less advantageous today. But where do you see that going in terms of its impact on oil markets, oil prices, the sentiment for supply going forward?
With Russia, so the U.S. and European countries imposed a price cap on Russia. Now, I didn't think it would work. It's actually worked pretty well. The reason is that the Russians have to discount their oil. And so what's happened is India, which obtained most of its oil from the Middle East a year ago, now attains a lot more of its, I think 40% of its oil from Russia. China is trying to line up as much of the Russian oil as possible, paying less for it. So the availability of this low-cost Russian oil is benefiting those countries that are the largest importers of oil, India and China, and actually putting downward pressure on world prices. Now that things have come up, strengthened some, particularly as the Saudis and Russia have cut production. The loss of the distillate-rich Saudi crude has pushed up diesel prices and helped support the whole overall price level. But it's, whether that will continue or not. And Saudi Arabia has sacrificed income to do that. I mean, if you do the numbers, Saudi Arabia would be making more money with a slightly lower price of oil, but they are actually sacrificing revenue, just as they did in the early 80s, to try to keep prices up. How long they keep doing this is an interesting question. But the Russian oil, the sanctions on Russian oil are depressing prices because these countries, the countries like India and China, go for the low-priced oil and have no loyalty to any of the Middle East producers.
Would you? I mean, you just said Saudi. You don't know how long they're going to go on. The big question, as you said, is how are they going to continue with these voluntary cuts into next year? There's OPEC plus quotas to be discussed as well and changed next year. I mean, you started by saying that you don't think that OPEC plus policy has been very successful. So do you think that we'll see changes next year to that? And will we see them try and continue? I mean, and is the purpose really to keep this $90 as a minimum for Saudi because it has all these projects and its expenditure to come?
What I don't understand, and that's why I'm kind of reluctant to say what I don't, what I'll say, I'm not quite sure what's going to happen. Saudi Arabia is losing money by cutting production. And just as they lost money between 1982 and 1985, and what they finally did in 1985 was say, okay, we're tired of supporting everybody else, and they pushed oil in the market, and prices went down to $10 a barrel. And they stayed low, really, until 2001. So, Saudis will try to talk other countries into cutting production so that the lower production will generate a sufficiently higher price to increase their revenue. That's going to be difficult, particularly with Exxon and Chevron buying U.S. producers and increasing production. My concern, I guess, what I don't understand is whether the Crown Prince understands the economics of the ship. I'm sure his advisors do. He has some smart advisors, but sooner or later it's going to dawn on them that they don't have the money for their grandiose plans, and if they want more oil revenue, they're going to have to work either to get a lot of other countries to cut production, or they're going to have to push more oil in the market, which would raise their revenue but drop the price down. Those are the economic hard numbers. I don't know how that plays out. I'm an economist. I'm not an expert on Saudi decision making, and if whatever I say will be wrong.
Well, I mean, even those experts on Saudi decision making are finding it hard to forecast what they might do next in terms of oil policy sometimes. Dr. Philip Verleger, thank you so much for joining us today on Halftime Talk. It's been great to talk to you.
This is very great. Thank you very much.